So the non-attendee who's landed is Greg Pennington, and therefore is Jo Ellen Perry here? All right, Jo Ellen, I want to know just in general what you think of Amazon as what it does as a company, what it is as a potential value investment. I want to do the person who laughed so hard next to you, but I won't. Is Radoslava Petrova here? Radoslava, that's you? Or you're just waving to a friend? You're Radoslava? All right. Radoslava, I'm going to want you to do an asset value for me. Okay? You have time to do it. And by the way, I want to do this because it's where you've got the financial information as of December 31st, 2008. We can clearly get a sense of how it's traded since then and what the conditions are that might make you buy it. So at the end, we'll do an update of where it sits today. Is Sam Fan here? Sam, I wanted you to do an earnings power value. And John Piermont. John, I got your email. We could talk after class, but I've got a car picking me up because I'm not too good at operating in the snow, so I'll have to do it next week. I didn't pick you for that reason, by the way. You owe it to Greg Pennington. All right, what I want you to discuss, John, is how powerful and sustainable do you think the Amazon franchise is, and where do you think it sits, to see if you want to buy it at the kind of returns implied by Sam's earning power or Radoslava's asset value. And Irene Popola, I want to know what you want to do. You want to buy it, sell it? You just have to probably give a one-word answer if we get to it. But you've got to do it with authority. All right, I want to speak to several things. People email me with questions. They're not bad questions, but they're almost certainly questions that you're not the only one who wants answered. So you really ought to ask them in class. If they're really stupid questions, I'll let you know, and I'll try and let you know gently. Of course, I won't, but you'll get credit for that in heaven if you're punished in this classroom. So one question was, when I took for Magna 4 years times 575 million, why did I do that? And what am I measuring? Are there people how many people feel it'd be useful just to say quickly what's going on? Okay, good. As long as there are some, okay. The 575 is what they spend every year on product development. It's buried there in the annual report. Their products typically have a 4-year cycle at a minimum. So if you look at the products that are there, the 4 years worth of products, they represent 4 years times 575 million a year of expenditures to develop those products. So if somebody was going to enter and reproduce that product portfolio, it would cost them 4 years, roughly at least, times 575 million, which is about $4.3 billion. Is that clear? I mean, I answered the email, but I basically said in the email what I just said now. So if you're the one who sent me the email, you're trying to get at what it would cost to reproduce the production technology, the product design, and so on that they currently have in their operations. Second thing somebody asked is, they sort of got it wrong. They said, why did I multiply 24 times 7.5 million for the sales? Well, I didn't do that. I multiplied 24 billion, which is the sales, times 7.5%. Where does that 7.5% number come from? It's a typical commission that you would pay an industrial seller of complicated parts for making a sale to a corporation. So if a company sort of just had to pay the commissions on generating the original $24 billion in sales, it would cost them about 7.5% of the $24 billion, which is about $1.8 billion. Is that clear how that? Because the principle here is always, somebody's frowning. You just look at your neighbor with the blonde hair. Is that something utterly not to do with? Okay. All right, the point here is that you're trying to make a list of what are the intangible assets, just like Bratislava will do for Amazon, and try and ask what would it cost, either by looking at, as we did for Home Depot, at generating those assets over time in a store startup, or by looking just at sort of what it would cost to buy them in available markets. Like for the labor force, what you have to pay a search firm to acquire that labor force. To try and ask the question, what would it cost to reproduce those intangibles? Before you do that, of course, you wipe the accounting goodwill off the balance sheet, because that's just a completely phony historical number of no interest to anybody. Are there any questions about that? Okay, the second question that was just asked up here, which is a very good question, is when we compute these returns, these target returns that you get at the current price, that's basically to answer the question, do you want to make this investment now? So when you have a 30% plus return on American Express, you probably want to make that investment. And we'll talk about with some of these other things how you look at a margin of safety. In fact, today we'll probably do that of the franchises going away. It doesn't help you with the sell decision, because if you try and back out a fair price from that rate of return, so you say, okay, I want a 10% rate of return, you're right back in the R minus G, because you're going to be dividing the earnings by R minus G to get that value at which you're going to sell. In practice, therefore, I'm going to tell you what to do when you sell. Never, ever pay more than 25 times net operating profit after tax. Because right away at that point, you're in Tano's land of dreams. And you don't want to go there. We know statistically that is a terrible part of the investment market to be in. Typically, I would advise you not to pay more than 20 times net operating profit after tax. So when you make the sell decision, I think you don't want to get involved in these stupid calculations of values for growth stocks. You want to begin to think in a general way, how much do you want to be paying for the prayer and the dream? Yes?
I have a question about goodwill. I thought you said in the book that if the assets that had been purchased would have to then be purchased by some second acquirer, that they actually should leave them on the book.
Okay, sometimes you have a private market value at which assets trade, just as you did in Hudson General. That's obviously very valuable information for calculating what these intangibles are worth. Typically, you don't want to rely on that by yourself. That's the first answer to your question. The second answer to your question is, in many, many ways, that book is not particularly good. And it should be clear that because it was a first cut, there were ways in which we were doing a crappy job. The reason this class is different from every other class is we are in the process of doing a second edition of that book that will be much, much better, and the collective material in this class is what's going to be in that second edition. Okay? So if there's a conflict between what I say now and what I said then, trust me now. I would have said, trust me then. All right. Are there any other issues that somebody else, I got an email from, I'm forgetting what their question was, but those were the two big ones. And you really show, yes, I do know what the other one was, because somebody said, why did I use 1.27 billion as the debt for Magna, not 5.8 billion? 5.8 billion is the total liabilities. That includes an enormous amount of non-interest-bearing liabilities that are, in the language which does apply from 6301, spontaneous liabilities. What you care about from an ownership perspective is the interest-bearing debt. So, and that is not 5.8 billion, that is 1.27 billion. Somebody said that there were a lot of questions on that. You asked the TAs and didn't get an answer.
No.
Oh, it was you? Do you understand the difference?
That was very helpful. Thank you.
Okay. But in general, you should ask those questions in class, because you're not the only one who is confused, trust me. Okay? All right, are you ready, Joella?
Yes.
Okay, so what sort of company is Amazon, and should we be looking at it as a value investment?
So Amazon is a 15-year-old online retailer for whom books, music, video, electronics account for 97% of sales. A third of their sales come from a marketplace that matches buyers and sellers. International sales accounted for almost half the total in 2008. At $130 a share, which is what they had in Value Line, it looks quite overvalued by my
Okay.
So.
Anybody have anything to add to that? Good summary. Okay, so why don't we just look in slightly a little more detail. So it was launched in 1995. It was originally going to sell books, and it is the dominant retailer in selling books. It has since decided to expand and be the dominant online retailer, period. Now, what do you think of that just broadly as a strategic move that Joellen identified? They want to be the Earth's biggest selection, lowest prices, and customer convenience. They want to do all online retail, they want to provide through third-party sales, and they want to do fulfillment services, which is basically collecting money and doing delivery. Anybody know the history of Amazon on fulfillment services? Anybody follow this stock? They've been there before. In the early 2000s, they built a bunch of warehouses all over the place in order to do their own fulfillment. Do you know what happened to those warehouses? They got closed. They were crappy at fulfillment. There were other local book distributors who had local economies of scale in distribution, and they didn't have big enough share to compete with them. Do you think the same thing is apt to be true today? Probably. That there are going to be distributors of these myriad products who have local distribution networks like Walmart or Best Buy and Electronics that have the local economies of scale, not them. So right away, you should be a little worried about the mission creep to fulfillment. What about this? The world, go ahead.
Well, there is a big difference in trying to get into the fulfillment services with video sales and with video sales.
Getting into the fulfillment business requires what? Scale where? Globally or locally? Are you going to deliver to Kansas City, Kansas from your warehouse in Oslo, Norway?
No, I do agree, but if I have 30 million sales, I can start thinking about having local...
Really? How much sales does Kmart Sears have?
Okay, but no.
How much?
No, what
Give me approximate numbers.
60 million sales would that create local...
Well, what kind of number does Kmart, does Sears have? And they're a big retailer, right? Oh, no, not 200 billion. Does anybody know the Sears number? My guess would be about 90 billion. How do they do in economies of scale and distribution compared to their big competitor? Walmart. What does Walmart have in sales?
It has 250, 300 billion.
Oh, probably close to 400 billion. So, does even at 90 billion, Kmart, Sears have enough distribution to have economies of scale locally?
Probably less than Walmart, but what if?
Okay, let's hold that thought. That's somebody who does everything too, and Sears is at a disadvantage to them. In distribution, is Amazon at a disadvantage to Sears? Right. How much of Sears of that 90 billion is overseas for Sears?
Zero.
How much is overseas for Amazon? Joe, almost 50%. So if Amazon's, even in the case, it's like 19 billion. Half of it is overseas, so you probably got 10 billion distribution versus how much for Kmart, Sears? 90. So you're 1/9 the size.
Okay, but
Now let's keep going. Let's do okay bucks.
Sears is growing at 2% a year.
Right.
Amazon is growing at 30% a year. How much time does it take to have local?
Now why do we, that is Tano and I, love you for saying that? What is it that makes us happy about that?
If there are people like me on the other side.
On the other side, extrapolating at 25% per year, at which point they will be bigger than China in 2050. And they'll do it while operating for most of that time at a competitive disadvantage in distribution. But what about in particular products? What about in electronics? Do they sell a lot of electronics? Keep going. You're doing a service to humanity. They sell a lot of electronics, but how much do they sell compared to Best Buy? Not that much. And when Best Buy was competing with Circuit City, who also had to do distribution but did have the retail fronts, what happened to Circuit City in that competition, even though they were much bigger locally than Amazon? They're bankrupt. Okay, so we've thought a little bit about this fulfillment services. What about going every place? What about the rest of this ambitious agenda that Joe Allen identified? Is this a good sign or a bad sign? Well, who was the last person who tried to be the world's retailer? Walmart. And how well did it work in Korea? And how well did it work in Germany? And how well did it work in Japan? Is being the world's retailer something that looks really practical to do? Is it a big market? Yes. Are there big centralized fixed costs? Is the cost of generating Amazon's infrastructure that high? Writing the software, keeping track of the traffic, keeping track of the accounts. If you put it that way, is there somebody who's apt to be better at it? I mean, if you want to buy a camera anywhere in the world, how is that purchase process going to start? You're going to go to Google and Google in camera anywhere in the world. Are you going to go to Amazon automatically for that? You may wind up as Amazon as the top choice, although then typically you'll probably use a price-based search engine to find, once you know your camera, to find the cheapest place to get it. But if you go to Amazon through Google, who owns the profitability there? Google or Amazon? Google. So the first thing about this company is they had a very focused strategy first, which was books, CDs, and music. And they changed. And they changed in a not particularly promising direction, at least in terms of how these people who've done similar things in the past and tried to rule the world, have done, especially in retail. Then, if you look as of December 31st, 2008, because that's the 10K we gave you, plus the value line goes a little after, but you can sort of read back the price. The price is about $60. There were about 428 million shares outstanding. That's from the value line. The market value of this stock is $25.7 billion. If you look at what you're paying for the enterprise, because you've got $3.7 billion in cash and about $500 million in debt, you're paying about $22.5 billion. Is that obscure? Is this an obscure company that's going to be overlooked? Is there a lot of analyst coverage of this company, say, compared to Hudson General? Next, is this company a diseased industry and a diseased company? Is there something bad about this, like Magna? Is Jeff Bezos got an 11-year-old daughter who he wants to inherit, or say a daughter with a mental age of 11, who he wants to inherit this operation? No, Jeff Bezos is a fairly widely respected character who has not gotten into trouble yet. The dividend yield is 0. The reported earnings, again, you have this for the last year, is $645 million, which gives you a price-earnings ratio of 40 times. The market value, the book value, again, off the balance sheet at the end of December is $2.7 billion. It gives you a market-to-book ratio of 9.5. Trust me, that's in the top 10% or the lowest 10% of book-to-market, if you want to do it that way, that Tano showed you. And has it had a horrible price decline? Well, if you look at the chart, it went down from about 100 to originally below 60, but it's gone down sort of from 100 to 60. Is that a bad decline from peak over this period to trough? Has this been especially disappointing? Well, what was the market at the peak? 14,000. What was the value sort of at the end of 2008? This is the Dow, about 9,000? Say 9,000, let's be approximate. What was the decline in the market? It was 5,000 points over 1,400, which is a little less than, but not that far from 40%. It's about 37%. So the market decline is pretty much what you see in Amazon. And lately Amazon has been going up. So when Joellen looked at this, is this cheap? No. Is this obscure? No. Is this ugly? No. Especially not to people like that. Is it been disappointing? Probably less than average, because it's also a high beta stock that goes down with the market. Are there intelligent people who own this? Well, there's Jeff Bezos himself owns 22.6%, which is a good sign. And then T. Rowe Price, which is a big management firm, but it's actually an investor called Bill Miller, who is a value investor of a sort, who owns a lot, but nobody else from the value community or people who have good long-term records seem to own this stock. So, Joellen, what's your final conclusion before we get into the numbers here? This is probably not worth wasting your time on. Anybody have anything they'd like to ask Joellen about that? Okay. Radislava, you ready? To do an asset value for... Oh, there you are. Why did she raise her hand then? Oh, okay. I thought you were Radislava. Radislava, go ahead. Do you have an asset value? Well, I mean, why don't we just start with a balance sheet? Go ahead. The arm didn't sound that promising. Go ahead.
The asset value is 8.3.
Well, no, why don't you just go down the balance sheet and see what we're buying here?
Well, the way I did it, total assets is asset value is 5.8 billion, with investments of 0.3 billion, and basically setting up UPME and accounts receivable.
Okay, so you looked at, and if you got a net asset value of about $5 billion, the book value is, oh shoot, that's the wrong, sorry, wrong chart. The book value is about $2.7672 billion. You've got $8.3 billion in assets, $5.642 billion in liabilities. So you've got a book value of that. You probably found another $2 billion in net asset value there?
Yep.
To get about $5 billion. Okay. Do you want to go through where that came from?
Sure.
Okay, so cash and securities, did you find anything?
Cash and securities of 2.8, 2.78.
What balance sheet are you using?
On page 6.
Yeah, okay. If you add cash and securities together, what do you get?
With the cash and market securities, it's 3.8.
Okay, it's about 3.8, 3.7 billion.
Right.
You have to do a big adjustment to that since they're all fully liquid. Okay, so those are not long-term investments. They're fully liquid. So one thing we're getting for our 25.7 billion is 3.7 billion in cash and securities. Okay.
Next, accounts receivable 0.8, but we need to make some adjustments for the allowance for doubtful accounts.
Right.
So I made 70.
Right. It's, by the way, it's in the footnote. They have an 81 million allowance for doubtful accounts. You just add it back, you get about another 100 million. So it's about 0.9 billion. Inventories, is it already FIFO or is it LIFO? So we have to add back a FIFO reserve.
Yeah, it's 5, so it's 1.4.
4 billion roughly, right. And then other is trivial. So current assets are about 81 billion above. Anybody have any issues with Radislava about that? Sorry, I'm bad on names. Yeah, go ahead.
One quick question on cash. It's not the case here, but a lot of the cash was overseas. You can just count this by some factor for tax bringing it back.
Okay. What about that? What is he talking about? Go ahead. Well, a lot of the cash was accumulated by earnings overseas. If you brought it back to the United States, you would have a tax liability associated with some of that to the extent it was earned overseas. Is that a big number? How can you figure out if that's a big number and worth bothering about? Well, what's the tax rate that Amazon pays? Is it a European rate of 25 to 30 and an Asian rate of 25 to 30? Or is it closer to 37, 38%? Sorry? No, it's close to 36, 37%. So they're already paying close to American taxes on this. So you're probably not going to take a big hit if you bring it back. Secondly, you necessarily have to bring it back if you have something useful to do with it. And if you keep it overseas because you need it to fund the growth overseas, do you ever have to pay that tax? So it's both deferred and it's probably not that large. Now, The reason for pursuing that point is this is going to happen to you if you become investors all day long. People who want to buy growth or who want to buy weird stuff are going to try and establish their credentials by making small, minute accounting adjustments that are both obscure, demonstrate detailed knowledge of the tax laws, and in the end, almost don't matter at all. When we wanted to do the Magna investment, the person who didn't want to do it at $19 a share said, oh, there are all these terrible things that you've forgotten, one of which was the repatriation tax on profits. The other of which was sometimes these profits are locked up in subsidiaries and you have to pay the tax when you repatriate them from the subsidiaries. Turns out, just as in this case, those numbers were trivial. Ordinarily, I would say, don't waste your time. But in a world where you have to convince people to do what you recommend, having command of spurious, trivial details is a skill of no small talent. So either, what's your name? So either hire somebody like Matt to go over it, or learn to do it yourself. But ultimately, do you really care about this now?
Not for this investment.
Not for this investment. Okay. Because you want to focus your research effort on what's important. But there is a culture out there where there are people who worry about that a lot. Are we going to write up the property, plant, and equipment, do we think?
Yes, the one that is given is an PP&E, which is 8x4, and I'm adding back.
And if you actually look at what it consists of from the PP&E footnote, what you see is there's the fulfillment assets, which we think are mostly warehouses, and software systems, which we assume won't depreciate. They don't, unfortunately, break it down into land and buildings. There's the tech infrastructure, which is computers. Now, if those are half worn out and the value of those is coming down extremely rapidly, that's worth probably at most a third of what the original cost is. You could replace that for $116 million. The software, presumably, you have to write. Now, it gets a little cheaper as people learn the macros and you have skilled people doing it. But $331 million in software is not going to be a lot for somebody who wants to reproduce what Amazon has. Construction in progress is already in progress. Other is not worth worrying about. You got a reproduction cost. Is this approximately where you were, about $1.2 billion? Versus a book value of about 0.8 to 0.9, so there's about $300 million in extra.
Yeah, I put the 311, but yeah.
Perfect. Any questions for Bratislava about that? Just a standard, just going through the original cost and seeing what you think is real. Does this one matter much? I'm sorry, what's your name again? The tax expert. Matt. Does this one matter much now in the scheme of things? Not a lot. I mean, if we're talking about a $25 billion market cap, the $300 million adjustment is worth understanding how to do, but is probably not worth spending a lot of time on and investigating, in contrast, say, to the land in Hawaii. And there's no obvious way to do it easily. All right, what do you want to do about intangibles, Radoslava?
Oh, I took them out.
Okay, so you took the goodwill out.
Yeah.
And what are the intangibles that an entrant would have to invest in to compete with Amazon? And what has Amazon got that are actually what is probably its most important asset?
Trademarks.
Well, it's got visitors. It's got traffic. It's got customers who are used to going there. Right? Is it easy to generate traffic for internet sites? Or is that an expensive proposition? It's expensive. You have to advertise on Google. You have to have repeat people who come back. So the biggest is the sales, which is really based on the visitors. How do you want to put a number on the sales? And one way is you can go to a consultant. There are lots of internet consultants who have a lot of experience with what does it take to build internet traffic for retail sites. The problem is they'll tell you it's a very different number for different products, and you may get into a morass. Or there's another way to do this, which is Amazon basically got to break even at about $8 billion in sales. In getting there, if you look at the net retained earnings, they lost about $3 billion. $1 billion of that was the warehouse fiasco. So if you think it costs them about $2 billion to build up an $8 billion sales base, it's about 25 cents per dollar of sales. Do we have an internet consultant here, or an internet retail consultant? Turns out that's not such a bad number. That driving traffic, it's going down and has been going down over time, but if you want to be generous, you can take 25% of the 19.2 just based on Amazon's history here, and you get about $4.8 billion. You subtract that, then of course you've got a labor force, it's 20.7. How do you think that labor force compares to Magnus? Do you think it's skilled factory workers and engineers, or... In fact, what do they include in that 20.7 if you read the employee note on the 10K? Temporary workers, seasonal workers. There are a lot of them, and this is a peak number for December. So probably, generously, you give them 5,000, that is 50,000 cost per worker, and maybe a 10% acquisition cost. But that's probably pretty generous. The thing is, it doesn't come out to be a very big number. It comes out to be about 105 million. So that's not going to be a big number. Then you've got the other, we'll just do it book value. We get assets, a book value of 8,314, a reproduction value of about 13,185. And that's being fairly generous. Yes?
I have a question about true intangibles. One is the supplier relationship, and the other one was the sort of...
What do you think of supplier relationships required here? Do you think that takes a lot of time?
They will come and once you have a large network.
Well, is that true? I mean, how does Amazon price the people who are on Amazon Market? Do you know how they charge them? Anybody read what the fee structure is for Amazon Market? They charge them a small fee for being on the market, and they charge them a percentage of sales. Suppose you are a supplier, and I come to you and say, I'll charge you the same percentage of sales as Amazon, and I'll actually pick up the cost of establishing you on the site, so you won't have to pay the fixed fee. What are you going to say? Absolutely. What do you have to lose? You think that takes a lot of time? We'll just funnel traffic to you guys on sales and we'll take a percentage? Is that really where the effort is? Is that what makes Amazon Amazon? That you can buy Sony TVs on Amazon? How many sites do you think you can buy Sony TVs on? Anybody ever Googled Sony TVs? Hundreds of thousands. So do you think it's their relationship with Sony that matters? Or do you think it's the customers who see that Sony TV on Amazon while they're cruising Amazon who go to Sony and buy? Yes?
What about the fact that we're able to turn our inventory into a day? That's pretty unique to the industry. That should have a...
Why do you think that is possible? And let me ask you, what part of the inventory do you think that is? We think it's the books. What's the nature of book sales on Amazon? Do they sell lots of bestsellers? Say Amazon compared to Barnes & Noble. Right. And do those books sell frequently or not?
No, but that's why I think it's valid for the relationship.
Right, but that's why I think that when the number you just cited is wholly phony. Why do I think that? Where do you think the inventory for the obscure books lies? At the publisher or at Amazon? So Amazon gets the order, it gets it from the publisher, and does the drop ship. What's Amazon's inventory in that case? Zero. For Amazon Market, what is their inventory? Zero. They're just passing on the orders. What does their inventory consist of, therefore? Fast-selling items where the customers want them quickly and where there's sufficient volume to justify the order. So is the denominator to which the inventory is applied the full amount of Amazon sales, or is it this small fraction of sales for which they actually carry inventory? Sorry?
You're calculating on the full amount.
Right. Is that an appropriate metric here? Is that 12 days anything but meaningless?
No,
Who touts that 12 days? Jeff Bezos. Why do Tano and I love you? Because you're not asking yourself about the economics of this business. You're looking at the numbers to justify your love for this business.
No, I would like to share. I'm not comfortable with $60 the price, or I'm a friend not comfortable at that price.
No, but look, let's at least figure out what's there. All right, so you could say it takes a complicated system to match orders with sending out the books, but most of it is you just pass the orders on. And you have a small amount of inventory for the high-frequency items. And that's not particularly difficult to copy. But you could put that into organizational capital. Some of that, by the way, is in this $323 million. Because don't forget, the software is in there. They count software as property, plant, and equipment. So the organizational software is already there.
What's the sales number again?
19.2 billion.
5%, what's the rationale behind that?
Oh, okay. If you look at Amazon's history, through the point at which they had about $8 billion in sales, they had lost about $3 billion cumulatively. That was what it took to get into that business, was $3 billion of accumulated losses. Is that clear? $1 billion of that was this bad mistake they made with the warehouses. So to build that business to $8 billion cost them about $2 billion from 1995 to 99. So it cost them about 25 cents per dollar of sales. It's very similar to the exercise we went through for Home Depot. What does it cost them to build that business? Although there we were interested in, was there any net value created in that process? But to put that 25 cents in perspective, do you think it's gotten cheaper or more expensive to build traffic on the internet since Amazon started? In 1995, was there a Google? No. I know, how old were you guys in 1995? Like 10? 9, 6, 3? But in general, do you think it's gotten cheaper, more expensive to buy these things? To create the traffic now. It's probably gotten a little cheaper. And you want to keep that in mind. Although, as you'll see in the end. So here we are on the asset value. If you look at book, the assets are $8.3 billion. The liabilities, including mostly a lot of payables, are $5.6 billion. It's about $2.7 billion net. And this is an equity value we're doing. Why are we not going to do an enterprise value? Because as long as there's net cash, let's look at the equity. We're certainly not going to be looking at an equity stub here, where there's a lot of debt in front of it. What are the adjustments we made? And this is sort of what we did for Magna. We added $81 million to the current assets, which was the allowance for bad debt. We added 4,905 for the intangibles, which is 105 for the labor and 4.8 billion for the sales. We subtracted the book value of goodwill because we're replacing it with our direct assessment of the value of the intangibles, which is 438. We added the extra PP&E that we thought would add the reproduction cost of 323 million, so we wrote up the net asset value by about 4.8 to 4.9 billion and got about 7.5 billion. That's a little more than, I got the R right, Radislava's number. In general, hers is probably a better number. It's not as generous. Why? Because she's not giving them 25 cents per dollar of sales credit for building the traffic, because she recognizes that that's not achievable. So this is probably a fairly generous asset value. Once we've done that, are we buying this thing for the assets? Well, it's got about 7.5 billion in asset value. We're buying it for 25.2 billion. We're paying about 3.5 times the reproduction value of the assets. So right away, there better be a lot of excess earnings here, or there better be, and therefore there better be a powerful franchise. Okay, thank you. Any other questions for Radislava? Next, Sam, where are you? Okay, what about the earnings power value?
So I wasn't really sure how to do on this. I made some assumptions.
Right, go ahead.
Assumptions. So if you look at tax adjustment in the past 2 years, it went up to 68%, and then it dropped down to 29%. So I made an assumption: what if they kept 30% for another year before settling off, or what if they kept growing 20% for 5 years before settling off? In both scenarios, like there were huge implicit growth rates that justify prices were changing.
Let me ask a question about that approach to doing it, because the obvious other approach is to say, look, what do we think is a sustainable margin here? Let's look at the margin history to see if that's in fact what has emerged, and just apply that margin to current sales to get a current earnings value. What's the difference between that and extrapolating sales growth? What's the real problem with extrapolating sales growth in a rapidly growing situation like this? And let's go back. Joellen? Is it Joellen? Go ahead. Why would what Sam is doing be fairly dangerous here?
I can't really hear what Sam
Oh,
is.
Sam is doing is he's extrapolating just operating earnings growth at 30, 25% a year from where
I
it
think
was.
for general things, it's to make projections for sales beyond any reasonable time frame, and then for a rapidly growing industry, so you don't know when the growth will slow down, you know it will slow down at some point. Right?
There's partly that, but is the mix of products here staying constant?
You're assuming a market fall, but what I'm saying is I was
Well, let's at least look at the margin history and see if, in fact, there is a pattern to margins. And what I want to do is do an exercise for you that is a useful thing to do, because we've been valuing this for years and making fools of ourselves because we thought it was overvalued at basically $40 a share. So if you look at the margin history here, there is the history of operating margins for Amazon. The reason we gave you the EBITDA margins is that when Value Line reports operating margins, they report EBITDA margins. Now notice they track but are slightly higher than the EBIT margin. So the value of the Value Line is you've got that long history in a very compact form. The disadvantage is that they do the operating margins not the way the balance sheet does. If you do the operating margins and you were looking forward from sort of the end of 2006, early 2007, what would be your sense of what a good average EBIT margin would be? Well, what do you generally see as happening there? Margins are shrinking. Now, is there an obvious reason in the business history why those margins are probably shrinking? Because as you go in, yes, go ahead.
Because you want to reach local.
You might want to reach scale, so partly you're reaching for scale, but also, yes, you're adding a lot of different products, and originally you're going to have the infrastructure for those products and not a lot of sales in those products. So as you add those products, they're probably going to lose money early on. And so what you see is, you see that reduction, which is also related, by the way, well, it's not really a slowdown. So you see the recovery from the losses. You have the reduction, and you start to see a slight recovery. We actually called people and thought a 5.5% EBIT margin adjusted for excess depreciation was about right. Yes?
Can you let us an idea on how the computation of VAT is different from the one on the account? Because if you look at the account number, the operating profit, it's not easy to do this.
Wait a minute, what number are you looking at?
I was at the operating income.
Right. These numbers should be operating income divided by. You only have 3 years of that in your handout.
I took like 2 more years
Okay.
from Capital.
Right, and if you did that,
and I got like from 6.2%, then I have a reduction at 60.6, but the last 2 years at 4.4%.
Okay. So you get it to the last years, and this is what you got. Right?
Yes.
So we were right that there was an increasing trend. But is there a story that this tells? And together with the subsequent history of basically going up to 4.4 and staying there. Well, is it a story consistent with the story that Joe Ellen told about this company? Remember, good investing is about telling consistent stories that are supported by the evidence. What was the story that Joe Ellen told you about the evolution of this company? It started where, Joe Ellen? Books, CDs, and music. Did it dominate that market? Pretty much. Online, it dominated that market. As it expanded to other markets, did its competitive position, its relative scale, improve or deteriorate? Deteriorate. So people who think you're going to get back to 6 and 7% returns are probably dreaming. That at best, when you do the correction for, and I'm running out of time here a little because I know you want to get your drinks, and this is the day I'm supposed to let you go early. That if you do the corrections for maintenance CapEx actually after EBITDA, what you're sort of getting is 5 to 5.5% returns. You're not getting those historical returns. So anybody who dreams that they're going back to 6 or 7 is probably kidding themselves. And you can see these returns seem to have stabilized. So let's be generous. Let's take that margin, okay, Sam? And let's take the current year sales, which is $19.2 billion. Because with something growing as rapidly as this, let's even take 5.5%. We have 105. The reason this tax rate is lower than the 36 that they actually pay is because some of this is excess depreciation that's tax protected. If you look at that, you've got about $700 million in NOPAT. What was your number for NOPAT? Sam?
Well, I had tax returns.
Yeah, that's after tax. What you have? 547. Now, that is defensible. Again, he's a little more pessimistic than we're being in taking this down maybe to 4.4, which is basically 80%. If you take 80% of this, what you've got is 560 million, which is very close to where you are. I think you're ignoring a little bit of excess depreciation, but we won't argue about that. How is this financed? When we do a weighted average cost of capital here, Sam, it's all equity. It's got a huge amount of excess cash, although whether it's got the excess cash is a good question. And we'll talk about that in a second. So it's got all equity. What kind of return would you want on this if the market return is about 8, 9, at least 10? Yeah, okay, 10% return. So we get here an earnings power value for the operation of about $7 billion. We've got the excess cash to add to that. We have an earnings power value of the equity of about $10 billion. What was your number, Sam, in the end?
3.3 net.
Your share should be about 8.
Per share.
Yeah. No, let's not do it per share. I don't want you guys to do per share. I want you to think of these as operating businesses. You do it per share, you'll start thinking of it as pieces of paper. We'll do the per share at the end when we have to. So you're probably, I'm guessing, since you're about $1.5 billion below here, you're about $1.5 billion below here, so you're between 8 and 9, $8.5 billion maybe.
I actually have 10.2.
Okay, so you're very close. So you're 10.2. The asset value was 7.5. The market value is 25.7. Do those numbers tell a story? Here. And I think, John, it's your turn. Where are you, John?
It looks expensive.
Well, it's not just that it looks expensive. Does it look like a particularly powerful franchise? Does it look like the earnings power is way in excess? And remember, I've been fairly generous on this earnings power value. Does it look like it's hugely, is this Coca-Cola where the earnings power value is probably 60 billion and the assets are maybe 8 to 10? Is that a surprise, John? Do you think this is a powerful franchise?
I think it's surprising somewhat. I think that I hope that if you're not live, they have on the website, they get that's a little better than that.
Well, I mean, have we given them credit for the eyes and the assets? Because acquiring the eyes is somebody else everybody can do. And if we give them credit for that fairly generously, what should this company be worth? Yeah, for the asset value. That's the 4.8 billion. Well, the crucial thing here is that when I treat the eyeballs as an asset, it doesn't look like they've got earnings power that substantially above the cost of an entrant coming in and reproducing this asset value. If they don't have that excess value, what does it say about their competitive advantage? Is it strong or not? Probably relatively weak. And where is it almost certainly concentrated, Joel? Right, in the original products that they dominate. And because really the key to a sustainable competitive advantage is local economies of scale, so it's where they've got them. And all the rest of this stuff, are they likely to outdo Best Buy in electronics? Is there a BestBuy.com? Worse than that, is there a Sony.com? How does the competition look between them and Sony and Panasonic and Samsung and Best Buy and local retailers like jrrichard.com if you want immediate delivery? How do they look competitively compared to them? Okay, they have a slight tax advantage, and what's that? That's a sales tax advantage they don't have to pay. And that's like 5 to 6%. Is that going to make them rich? Sam?
It seems like the nursery is moving towards direct sale with everyone.
we were here 20 years from now, how would you expect you would buy your TV set? Through Google. You go through Google, you might go through a shopping site that finds the lowest price. If you wanted local distribution, there would be a site that would find that at the lowest price. What's the role for Amazon in that world, John? So in a sense, this is disappointing because you are paying for a ton of growth. But the conditions for that growth to be profitable are not necessarily fulfilled. And if you're going to pay for it, you better be sure that it is there. So this is a case where you're really counting on the franchise and growing competitive advantage. That is, adding sales in a market in which they enjoy a competitive advantage is crucial. So you have to think about the structure of the industry. You have to think about the structure of returns, the history of share stability. Is there proprietary technology here? You just tried to say there was. In inventory management.
They can reach scale.
Okay. No proprietary technology. Is there customer captivity? There is habit formation. When you buy a TV set, you buy by habit. When you buy consumer electronics, when you buy an iPod, you buy out of habit. You go look for an MP3 player, how many people looking for a 38-inch, let's assume you guys are going to be well off, because you are, a 38-inch high-def digital TV. How many people here just automatically go to Amazon and pay their price? What does that say about customer captivity? Yes?
Right, but, I mean, for books, I actually go straight to Amazon for books or somehow. So
Books and music, and do you go to Amazon as much for music as you used to? Where do you go for music now? iTunes. So you do go for books, you probably do go for CDs, but music is probably a dying business. So you want to look at the structure of the industry, and you've got to look at it segment by segment to ask if these things are there. And there are a lot of segments here. There are people doing technology solutions like IBM and web services extremely well. There are applications developers who do multiple applications of this, and they tend to be where? India often. It's low cost. There are lots of third-party aggregators. That's Google, Yahoo, Overstock, eBay, Walmart, Target, Wholesale Club, and then there are the specialty ones. Does that list look like it has a dominant competitor? And is it Amazon? It sure doesn't look like it. In retail, in bookstores, general retailers, it certainly doesn't look like it either. So you've probably got a franchise in one part of the industry. So if you look for franchises here in terms of captivity and share, yes in books and music, and you see it in the old returns on capital, no in other things. Is it sustainable? Well, that's the tough thing on the web. Is there enough customer captivity on the web to sustain the scale that you need? If you do that, what you'll see is if you do the return here, in terms of return for this as a growth stock, say you have $700 million in net operating profit after tax, including the excess depreciation. For the enterprise as a whole after the cash, because you are buying some cash, if you're paying $22.5 billion, that's an earnings return of 3.1. Where is that earnings? None of it gets distributed. It all gets retained. Where does that 3.1% go? What do they do with it? No. What's happened to the share count? What's happening to the share count? The share count is going up, not down. On balance, they're not buying back stock. You see that? Where? Just look at the value line tear sheet. You'll see the share count has been going up steadily. Yes, go
Does that
ahead.
mean you take a minus 2%?
No, what is that? Look, they make that 2%. They reinvest it. What are they reinvested in? Cash. If they reinvested in cash and say they earn 1.5%, how much is that worth to you? 1%. Why? Because they pay corporate income tax on the 1.5% before it gets to be yours. So at least a third of the value gets eliminated from that cash because of the two-layer of income tax, which is they pay corporate tax. And do you think they're going to give, is there any indication they're going to give it back to you anytime soon? No, there isn't. And if you look at the returns, you look at the interest earned divided by the average cash balances, did anybody look at what that number looks like? It's really low. And it's been really low for a long time. In fact, it's much lower than Microsoft's return on cash. Does that suggest something that you really have to worry about here? Because what do people say is the great thing about Amazon? As it throws off cash, right? Because it has less inventory and receivables than it has payables. It's financed by its suppliers. Does that make sense? Let me tell you a different story. What's your name again?
Commander Beats.
It's not. Tell me the story. I just find the first name. You are Tommaso?
Yeah.
What's his name? Okay. Francesco is telling himself this story, and everybody says it's so great that they have negative working capital. Suppose they do it this way. In the month before the end of the quarter, they really piss off their suppliers by not paying them. So they run their payables up, and they report high payables at the end of the quarter. And because the payables are high, what's also going to be high? Cash. Because they haven't paid out any cash. What do you think they do the day the quarter is over? They pay all their suppliers so they're not pissed off anymore. Do you think anybody has a competitive advantage in screwing their suppliers? Unlikely. If you don't pay them, you're going to wind up paying a higher price, not getting price discounts, getting worse service, and so on. So basically, this is cash that you're never going to see. They're using it to run this manipulation of the stock price to make people think they're a negative working capital company. So basically, you're going to write down that 2% or that 3% by about 2/3. Is that clear? This is a negative NPV investment. Yes.
So on the previous slide when we were doing the earnings power value, you added cash, but shouldn't that be offset by the
Yes, it should. But I'm being generous to these guys. So I have a 2% return from the operation. And then the question is, and that is the dividend plus the value of the retained earnings. What's left for the overall return? Just the organic growth. And what we have is we have a lot of history of projections on growth for books, and this is what they look like. Books, movies, and music, and of course this number for music is way below what people thought it was going to be in 2006, 2007. That 27% growth rate is not in the value-generating part of the business. The value-generating part of the business is probably growing long-term at 7.5 to 9.5. If you want, I'm going to just show you quickly some sources for that growth data, because that's obviously what you'd be interested in. The U.S. Department of Commerce does forecasts on internet sales and their growth rates, and also the percentage of online sales from the total category in 2011. And other people massage those numbers and reproduce them, so you actually have surveys going forward. So if I look at this as an investment, and here's where you want to do a scenario. If the franchise survives, they're going to make about 2% plus, say, 7.5% organic growth, which is 9.5%. If the franchise evaporates, and we'll talk about what's going to cause that, because it has in music, they're going to earn the asset value. Remember, the asset value is about 30% of the market value. You ought to earn about 10% on the asset value, which means that you're earning about 3% on the market value because the asset value is only 30% of the market value. Is that clear? So if the franchise goes away, what's going to determine your profits? The asset value. Okay? You're going to earn 10% on that asset value. You divide that by the whole market value will tell you the return you're going to get on your investment. If you have that level of profits with no franchise, divided by what the $22.5 million you're paying for the company. It's the asset value of 7.5 divided by 22.5. So you basically are going to earn 30% of the cost of capital, which is about 3%. So you have a scenario where the franchise survives, you make 9.5. You have a scenario where it evaporates. If you can't figure it's a third chance it survives, a third chance it evaporates. The overall return, which is a third of this, which is 1%, plus 2/3 of this, which is about 4.8, is about 4. It should be 4.9% versus a market return of 7.5. If you think there's any significant risk of franchise evaporation here, are you going to get a good return on this stock? Extremely unlikely. This is what it looks like today. It's not $60 a share, it's doubled. It's $120 a share. If you look at operating income at about 5.2%, it should be 1 point. This is higher than is actually reported because the margin was 4.6. It went up slightly. If you look at 2009 where the numbers are in. If you adjust it to 5.3, you get about 1.35, and this is for excess depreciation. You take a third tax, you get about $900 million in NOPAT. There are about 444 million shares. I said I'd do it for you at the end. It's about $2 per share. The earnings yield is therefore $2 per share divided by 120, which is 1.6%. They're reinvesting that in cash and destroying about the third of the value. So today you're earning a value-creating earnings return of about 1% on this. So what has it got to grow, ask yourself, to justify, and value-creating growth, to justify that price? And let's talk about, where's my final person? Let's talk about the Kindle. Sorry?
I was supposed to say just one word.
Oh, okay. All right, say the Kindle, good or bad? Bad. How do we know that? Where did we see the Kindle before? In what industry? Music. It was called an MP3 player. You went from hard copy to electronic copy. Was that good or bad for the music retailers? Was that good or bad for Amazon and their profits from music sales? It was bad. If that happens in books and ultimately movies become downloadable too, what's left of Amazon's franchise? Nothing. Now, you want to buy Amazon, yes or no? If you want to buy it, how many people wanted to buy it when they did the valuation? How many people want to buy it at 120 today? Lots lots of luck. Probably next year it'll be at 240. The first time this happened to me was a stock that, when we started doing it in 1992, was trading at $12 a share. By the time I'd finished doing that stock, it was $60 a share. Where do you think it is today? About $6 a share. So in the long run, you probably want to trust this analysis. If you're going to buy this, my advice to you is watch it really closely and don't get greedy. All right, I'm going to let you go 15 minutes early. It's going to be a long class next Tuesday. We've got basically 2 lectures to cover. So I'm going to take the time back from you on Tuesday.
Yes, thank you. All right. We can talk about, are you asking me about the growth? Say something more. Give up the homework. Amazon growth cheap, you got it?
The investment ideas is next Friday. It's in EDM, and you went until late. Most people are employed securities.
You can present early and you can go to